Welcome to the Three Edge Week in Review for the week of January 25th. I'm Fritz Folts, Chief Investment Strategist here at Three Edge, and I'm pleased to be joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at Three Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing a topic that we refer to as Casino Wall Street, as we take a closer look at the increase in speculative fever that seems to have surfaced in markets recently. Before we get to that, let's take a look at the markets and how the markets have done this week. An up and down week in the middle of the week ended decidedly down by the end of the week. On Friday, global equities declined broadly, and markets turned in their worst week of performance since fall of 2020. There was an increased level of anxiety among investors that recent massive retail trading was causing havoc on Wall Street, and there's also growing concern over the amount of vaccine that is currently available in the race against the coronavirus, and in particular the new variants of COVID-19, such as the strain of virus that emerged from South Africa, which seems to be spreading fairly rapidly. This week, as stocks declined, U.S. Treasury yields rose along with gold. In the category of something to perhaps keep an eye on going forward, in the U.S. there remains a veritable mountain of available liquidity, which has now sent short-term U.S. dollar borrowing costs to record low levels, while in China, money market rates surged to their highest level in almost 6 years, reflecting tighter financial conditions there. So now let's move on to our topic for today's video, which is Casino Wall Street. And as equity markets continued to move higher, having set all-time records just 2 weeks ago, we're seeing more and more signs of what could be described as examples of fairly rampant speculation, particularly from amateur investors on sites like Robinhood. In fact, retail trading on Wednesday of this week helped to drive equity trading volume to over 24 billion shares, which exceeded the prior peak, which was set all the way back in October of 2008. One example of an area where investors seem to be making speculative bets is in cryptocurrencies such as Bitcoin, which, as we know, rose from its March 2020 low, price of around 9,000 to reach over 40,000 per coin recently before declining this week. And then, of course, recently we have witnessed stocks being whipsawed by internet chatter. The prime example of this is GameStop. The outlook for the company, which basically sold video games and components out of shopping malls, was not exactly the perfect business model for a global pandemic. And so the outlook was rather dire, and there were hedge funds on Wall Street that were shorting GameStop stock, hoping to make money should the price of the stock decline. All very normal stuff. However, what happened next is fascinating on a variety of levels. A group of retail investors on trading platforms such as Robinhood, communicating through Reddit board called Wall Street Bets, started collectively buying up shares of GameStop, thereby squeezing the short positions of the hedge funds, since as the price of a stock moves higher, short sellers begin to lose money. Then, as with all things internet these days, the phenomenon went viral, and there was so much buying of GameStop stock, including short sellers having to cover their positions, that the price of the stock rose by 400%. So Steve, these are clearly examples of speculators being drawn into the markets, and it isn't necessarily new, except for perhaps the sheer number of speculators now which seem to be playing. And what could be important here is that when we do look back at bubbles from the past, I do know that one of the components that's sort of part and parcel of a financial bubble is this increase that you get in speculative behavior as the bubble really gets close. Really inflates to very high levels. But I also know that a bubble and a bubble bursting is a combination of factors. It's not just speculation. And so I'd love to get your take, first of all, on this idea of Casino Wall Street and what's happening in this area of speculation. But then also maybe I think it would be helpful if you were to sort of round out the picture about the other things that one needs to look for when trying to think about financial bubbles.
Well, Fritz, as students of market history, and you and myself and the others on the investment committee have been students of market history, we've analyzed a number of stock market bubbles that have occurred over the last 4 centuries. You go back to the 1700s, and there was a famous stock market bubble period in 1720 started in England and France, and it created what's known as the South Sea and Mississippi bubbles, rampant speculation. We've had the bubble in the 1920s. Japan had their bubble in the 1980s. We had this tech stock bubble in the year 2000, and now we're seeing a lot of bubble-like phenomena today. But one common theme through all these bubbles is that they most often coincide with excessive central bank money creation. And that was true back in the past, it's true now. Secondly, human nature repeats itself over and over. And if there's one aspect of the global markets that doesn't seem to change from year to year, from century to century, it's human nature. And what we see is in times of bubble-like mentality, usually when there's too much excessive money printing, we see speculators who perhaps get bored with the long-term investing methods, and frankly, they want to make a quick buck like a gambler.
Right.
And they ignore anything about valuation or economics, and basically it's all about riding a trend. And if you can ride a trend and it keeps going, you can get off at a higher point and make some money. And so you get a lot of people all trying to ride the same trend. And that's when human nature gets involved, because greed sets in. You ride the trend, you make money, you can't believe you made so much money in a short time. And rather than going ahead and taking profits and being thankful, well, maybe we can make even more money. And so those trends persist because people want to keep riding the same trend. And yet it's a zero-sum game. For every dollar that's made in the short-term speculative trading, just like gambling, there's someone's losing $1. So it's a zero-sum game. And what I can say is, from all of the bubbles we've studied, the hardest prediction to make is, when does this bubble going to burst?
Right.
And there's so many examples where people could use logic and mathematics and experience to show how the bubble is overly stretched, how it makes no sense. And then the bubble can continue for days, weeks, months, even years. There are a number of examples of that. On the other hand, the easiest prediction to make is that the bubble is never sustainable, and that markets always find their way back to reasonable value. And that's the easiest prediction to make. So what's hard to tell about what's happening today is that while it's certainly a symptom of a bigger picture phenomena, too much money printing, too much speculation, overvaluation. By our measure, the US stock market is more overvalued than ever before. These are all symptoms. It is true that this could continue a while longer, but it's very unlikely that it would continue in a sustained way. So right now, as a firm, we are on red alert. We are watching all the warning signs. We have the advantage of having our models take in lots of information to look at what are the investor behavioral factors that we track in our algorithms to show how this is starting to turn. When is it time to start taking some additional risk off? What are some of the other factors that might come into play, like credit spreads? Right now, credit spreads are the difference between what people get when they lend money to a low quality company. It's not that different. It's really quite narrow, near record lows compared to what you get when you lend to the Treasury. And we know there's a great vulnerability when that starts to widen. That's another sign to get out. So we've already begun our protection mechanism some time ago. When the valuations get extreme, we already reduced our allocation of U.S. equities to our minimum levels across our strategies. So that's a step. But we are certainly looking very closely to when that next step might come, and it could be quite soon.
Excellent. Thank you. And thank you for providing your perspective on financial bubbles. And I know this is a topic of great concern for investors currently. You know, people are really talking about it. I saw a really good quote recently from a portfolio manager, and he was asked about, you know, this idea of, well, you know, how are you positioned, or how are you thinking about this market that had reached, you know, all-time highs recently? And he said, well, in terms of the market, the music is still playing, and so I'm still dancing, but I'm dancing much closer to the door. That's well, that's a pretty good description. So anyway, thanks for your insight there. That will do it for Steve and me. We'll be back next week with another edition of our Three Edge Week in Review. As a reminder, all of our Three Edge Week in Review videos are available on our YouTube channel, as well as on our website at 3edgeam.com. If you'd be so kind as to subscribe to our YouTube channel, you'll just be notified as we release additional videos in the future. On behalf of everyone here at 3 Edge, we urge you to remain safe, stay strong, and keep the faith. Thanks for listening.